We are back, guys, with another episode of the BLD Financial Podcast, and today we have a special guest. Like every guest we have, always special. We have Graham Morrison today, and Graham is the first appraiser that we've had on the show. Graham works for AY and is a phenomenal part of our team. Has helped a ton of our clients with commercial appraisals, and has a ton of insights into value, what's changing, how it's changing, and in a market that we've gone through over the last few years and in the swings of the values, it's important to have somebody on to talk about what's actually happening and what we can expect. So Graham, appreciate you having on, brother.
Thanks for having me.
Yeah, why don't you tell the people a little bit about who you are, what you do, how you got here?
All right. I started back in 2013, right out of school. I joined a small appraisal firm called Metrics Realty Group.
Metrics.
Yeah.
Pumps out all the good ones.
There is still, I think, an operating shop out of London, which Dan Van Hoot runs. I started out doing residential appraisals for 3 years. And then in 2016, we got acquired by Avison Young. And then since the merger or the acquisition, I have been doing commercial valuations since 2016. So, and that was still working as a candidate. So I would have a co-signer, Paul Stewart and Matt McWaters. You'd do your reports and they'd have to sign off on them.
Yeah.
And then in 2021, I got my designation. So you can sign off on your own reports and sign for other candidates. And I've worked my way up to a team of 6, I believe now. And that's where we're at today.
And you guys are downtown Toronto, focused right now?
So our Avison Young appraisal office was up in Markham.
Gotcha.
But now we've got this new office downtown at 222 Bay Street. So pretty much everyone's moved there. Just better space.
If you wonder where all your fees went, it went to the Bay Street office.
That's right.
30% bump right there.
Yeah.
You got it.
Let's get into values, man. We have seen massive variations in values. We saw COVID, and then we saw extremes on both ends. Interest rates drastically hiking, drastically being cut, and values being kind of a bone of contention in regards to just variations and swings. So, right now, what are you seeing? Because there's a lot of kind of I don't say turmoil in the market, but in the commercial side,
uncertainty anyways.
Yeah.
Yeah. So I would say in the industrial space during COVID, you had that big boom. A lot of e-commerce was getting people to buy big logistics, warehousing.
Amazon and stuff.
Amazon for one, but even the smaller companies, they're buying up industrial space. Even for storage. So you saw a big boom in the industrial land prices and industrial building prices. Going into 2025, I think you're going to see that those are kind of stabilizing or maybe coming back a bit, just due to the decrease in demand in that space.
Just like the economy contracting a little bit in regards to spending, and they're not needing the space anymore.
That's on the industrial side. I know you guys do a lot of multifamily. So in that space, for us, it really depends which market you're in. So we do all over Ontario. It's going to be different whether you're in Toronto or Ottawa, all the way down to Windsor. So I'll let you guys, where do you guys want to talk about?
I mean, we're kind of all over the place. I mean, GTA market is always interesting, but I think from what I see, maybe you see something different, but Barrie, KW, Hamilton, London, I think are the main kind of number one, primary markets. Obviously we do some stuff in GTA. Going east is actually a very interesting market right now, into the Belleville area, on the power corridor, there's a lot of very interesting values. Overall, I don't know. I haven't seen value. I think multifamily was obviously healthy because the values were able to stay relatively consistent. Just from what I've seen, maybe you can obviously touch on that too, but I think like, part of the reason why investors got out of the multifamily or out of the like single family res side and getting to the multifamily is that you're not relying on like your comp based data, which was like destroyed over COVID, right? When you're not selling properties, you don't have comps to be able to support the value, where like on the multifamily side, at least you're able to support that with like your income and your cap, which, caps are, interest rate related somewhat and can be moved that way. But if you buy a building and you force appreciate it, it's your value is there, right? So, I mean, maybe kind of stick to those markets. I mean, I don't know if you had another market that you wanted to
yeah, well, I mean, those are really the markets where investors, what the mid-sized investors are looking to, execute in. Most of the time for our clients on the multifamily side, they're purchasing pre-existing multifamily real estate, underperforming assets. They're going in, finding opportunities. They're stabilizing the building, restructuring the debt after the fact. Those multifamily acquisitions that you're seeing right now, like, are they, are you finding that people are still purchasing at inflated cap rates or smaller cap rates? Like, when you're seeing all these acquisitions come to be, like, what are you seeing with that?
In Toronto, I think there is some room for lower cap rates if the building, has long-term tenants, and, you got a potential for rental increase when you can turn over the unit. So you might get some low cap rates on those transactions, but if everything's at market, it's going to be around, 4.25 in Toronto. In the outer markets, I don't know, we'll probably, depending on where you go, could be anywhere from 5 to 7.
Yeah. I think like one thing like listeners might want to hear too is, like, and I don't know how much you can really touch on it, but, in terms of your data points, because, cap rates, as much as they are tied to the economy, but they still can be somewhat from the perspective of who's doing the appraisal and the appraiser firm. Obviously, you can get AY data, you get CBRE, you get Colliers data. They're going to be pretty like accurate within like probably 90%, but there are going to be some differences. Like, do you maybe want to just explain like how you guys like derive your cap rates, like where those come from and where you guys getting your data? Are they lagging indicators? How up to date are they when you can put together census data?
They're always going to be lagging, usually by a quarter. So for us, when we're doing the cap rate section, we have our market report. So AY puts out a quarterly cap rate report, but then we also want to look at transactional cap rates. So what in the area has traded, and we'll kind of use the benchmark cap rates and see what the transactional cap rates are, and then if it's a purchase that I'm appraising, then we'll see if the going in cap rate is in line with the transactions or the market report. And if it's a refinance, then you kind of got to pick the cap rate that you think is in line with the other comparable sales.
And essentially you're looking at like quality of finishes, size of project, location, all those different variables.
Number of suites, location,
Gotcha.
Finishes.
And the data set that you're looking at. So, if you got a report in front of you and you're looking at that, are you looking at 20 properties to find that average? Are you looking at, specific, like your data is more confined to a specific area, and that's the most like reflective data in regards to cap rates? And I guess the further you go out, the less reliance you spend on those ones?
I would say location and number of units.
Gotcha.
Like you want to be those two. If you can get 8 to 10 cap rates, going back 12 months, say, then you're going to get a good average of capitalization rates for
and this is probably
report.
And this is probably why multifamily doesn't see cap rate expansion or compression as fast as you would normally see things go through the market, right? Because I mean, if it takes, let's say, 90 days, 120 days to sell something, and most of these things are cash flowing assets, odds are you're not going to have a ton of comparables that are going to be reflective of a shrinking or compressing cap rate, right? Like I'm assuming it takes quite a bit of data to move that cap rate in a certain area.
And like you said, there's always going to be a lag. If I'm getting a cap rate that closed in December, it could have been a deal that was done in August or September.
Yeah.
If there was a 90-day close. Yeah. So we're always a little bit behind in terms of the info we have for cap rates.
I think there was also a period too, like over COVID, where there was a point where their interest rates got so low and the whole idea of repositioning became so popular that, whether it was from the realtors or the sellers who were in the industry and, understood what's going on, but like they were also just building in that price to the sales price of like, hey, you got a 20 unit building, but what the client is or the buyer is going to do is they're going to take, 10 of these units, they're going to kick them all out, they're going to turn them over. They're going to take a $2 million building and turn it into a $3.5 million building. So instead of selling at $2 million, we should sell it at like 2.5 or 2.7 because, you're selling them a building that has this potential to be turned over. And like, I don't know if you guys saw that, but like, was there an impact from that? And I know that lasted for a while too, where sellers just weren't able to get over those like hot COVID prices. And they're almost like holding on to that era of like, hey, I was selling this building like last year for this price, or buildings were going for this. Like, I don't want to sell it for less than that. And I know there were some instances of buyers paying that. But like, did you see any sort of, like effect of that with the cap rates of buyers or sellers hanging on to
or
those
even
prices?
if they had an appraisal from during COVID times and somebody told them it's a 3.5 cap.
Yeah.
Well, that's just not the reality today. So now there's other ways that maybe they could have got their value back if they, had some turnover in the building and they got some higher rents, or maybe they managed to lower their expenses. But a lot of the times you're not able to get back to that value that they're expecting.
Yeah, and you have like all these purchase comps at like, let's say you're a regular like a 5.25 cap in Kitchener or what may have you, and then people buying at like 3.7 cap. You have all these purchases that can confirm a low cap rate, but someone's just buying based off of the ability to be able to turn over and make money on that cap rate. Like, the data that you have would probably be skewed, would it not? Like,
yeah, and a lot of the times you're not able to find out, you can get the NOI for the building, for the transaction, but you don't know what each suite was rented for every cap rate transaction you're looking at.
Yeah. So it's kind of like a gray area or a blind area that you're, making assumptions and taking a look at the data that you have. Like what data, like you guys obviously have a database, and that database would give you what the NOI, but not the rent roll. Like what data do you see on the back end?
So for us, we use CoStar. We do have the ability to talk with brokers who might have some info for us off-market transactions. But even then, there's confidentiality. They can't share clients' rent rolls and stuff with us. So we're limited in that capacity. But we get our market reports from a couple different sources. So the CoStar cap rate report, we have the Avison Young quarterly cap rate reports, which is from a lot of the data is from our own brokers. So
Gotcha.
That's kind of how we justify our cap rates when we're doing appraisals, using those sources.
Yeah.
Interesting. It's kind of like a veil. Like no one really knows how like the value is made. The report just shows up and it's got a bunch of comps on it. So
I think it just becomes like identified now. Like Toronto is at this cap rate, give or take, like maybe 10, 15 like pips on that like percentage, right? And I think it has. I think it's been, whether you want to call it stable enough for the last few years, but I think the cap rates have been in that certain range for so long that areas have now just been like, hey, if you're buying in this cap in this area, or if you're refinancing in this cap in this area, like it's just now deemed appropriate. I don't think cap, like obviously the overall dollar size of the building, you get be larger the more sensitive you are to movements in the cap rate. But for a lot of like the mid-sized markets, at least, like, yeah, obviously there's the movement of the cap rates with the shifting economy and stuff. But I find like it's within enough reason that like, again, like the cap rates you don't have like huge shifts on what the cap rates are. And I think that is just due to, again, with certain areas being kind of priced in at certain cap rates and not really wanting to move like too far out of there.
And to your point, like when, we get the value from the income approach, we also have to do a direct comparison approach and make sure that we can support the number that's, being driven by the income approach with direct comparison sales. So on a price per suite basis, if you're getting an income value that's showing $500,000 per suite, but you don't have the sales to support it, then there's going to be something's not right with your report. So
Can't tell you how many times I've had that conversation. They run the NOI on like a per unit basis, and it's like, no, it's worth like $7 million. And like, it's really not. Like, you have to have a comp recently sold in the area to be able to support the per unit basis on top of the cap rate.
So yeah, if somebody's doing a new construction, they put all their highest rents that they think they can get, and they're like, oh, it's going to be 800 a unit. And then you go look at the sales, and you've got, your highest is $550 per suite. So you got to talk to the clients and kind of manage their expectations when that happens.
Well, I think we actually ran into that. There's a bunch of new kind of investment trends that are happening in the GTA. The 4+1s. People trying to make these luxury units and trying to squeeze as much NOI out of these things as possible. But sometimes it can be rather challenging to be able to find that NOI when there is no comparable sales of the new asset that people are building.
That's the issue with those new 4+1s is, they're just kind of getting started. It's a new market. It'll be interesting to see, what those will go for on a price per suite basis for a brand new 4-plex with the garden suite. And then, once those transactions happen, then you'll be able to kind of see what it's really worth.
Everyone's just waiting for the first one.
Exactly.
Yeah.
That's it.
Yeah. I mean,
Someone's got to start the trend. So.
They're just finishing now. Like the ones who just started, like most of them are just finishing. So, and I feel as though you're not going to have any sale comps. Nobody's going to sell them.
No.
You're not going to have any of them.
So it'll probably be another 12 months before you see a sale of one of those.
Mm-hmm.
What we got to do is got to have all these investors coordinate. One person sells it. And,
Yeah.
and you sell it to the other person for like $10 million.
We can dictate the price of the market
Exactly.
moving forward, so it just has to be like a cooperative movement here. Everyone has to be on board.
That's funny. Yeah. We actually had another gentleman come in, and we were talking about just trends in general in the GTA and what that looks like for condoizing smaller multis. And we kind of had a little bit of a chat about this before we went live, but market shifts in general with like increased densification and the GTA. Like, are you seeing more? I'd say like retail investors get into this space on like the mid-sized stuff in Toronto. Like, what kind of stuff are you seeing that's moving? Like, I'm assuming you have a wide range of services that you're offering. Like, is it mid-size? Is it infill? Is it industrial? What's going on?
I would say a lot of it's been like the, where they get the as is and the as complete. So they're buying something that's maybe, a retail on the ground floor with a couple units above, and they're getting permits to turn it all into multifamily, right? So they'll renovate that retail space, put 4 more units in there, and then they come to you for the takeout financing with CMHC.
On those as complete appraisals, like obviously, there's a certain amount of documents that are going to be able to help create more accurate, valuations. From your perspective, like if you could get the ideal package from someone who's doing an infill, like what can they give you that's going to best help you determine that as completed value? Like what kind of documents you're going to want to see? Is it drawings, obviously, or pro forma? Like what's going to give you your best?
So
ability?
we would typically ask for the architectural drawings. We want to see the budget. And if they have their projections or pro formas, then we'll take a look at that too and just compare, what they're expecting that the units are going to rent out for, and we'll check the leases in the area to see if they're kind of in line with what they projected.
Yeah, and if they're maybe not so sure on their pro forma, or it's a brand new asset without any pre-existing, like brand new building, you guys are obviously able to kind of assist them with figuring out like, hey, similar buildings in the area per unit, your property taxes are going to be here, your insurance is going to be similar to that.
Yeah. So if sometimes people don't have any pro formas, so we have to do it all ourselves. We'll take out their suite mix and then assign a rent to each unit, maybe back off 2 to 3% for vacancy. And then for the most part, if it's going to CMHC, they have all their benchmark expenses. So, the salaries, the repairs and maintenance, management fee, reserves for replacement, those are all benchmarks. So you're going to put those right into into your expense side, and then the only ones you're projecting are the property taxes and insurance, maybe the water and gas if the owner is going to be paying that. But from there, we would use our reports that we've done in the area and kind of see, what's the average taxes per suite, what's the insurance per suite, and then we assign that to their pro forma.
This is important because what we're seeing now is CMHC is now coming back and they're saying, well, we're going to use the cap rate on the appraisal to be able to determine the value, but we're going to use our own benchmark expenses. So, what we saw historically was, not all commercial appraisals had all of these CMHC benchmark expenses in them. So, now that we're seeing, if you have an intention of, building like an infill development and you want CMHC and you're going to get your takeout financing, make sure you have the actual benchmarks in CMHC to determine your NOI, because CMHC is getting a lot more picky now with taking the actual cap rate and applying it to their NOI, not the NOI that was done by an appraiser.
And what other kind of pushback do you guys get from CMHC?
Oh, let me get the list out. Let me.
I mean, we can go into it, or I guess you could go into it further, but I think overall, the biggest thing is obviously rents are a huge thing, right? I mean, your biggest indication of value is where your NOI is, right? Being way above market rent when you're underwriting your pro forma, it's such a bad idea with CMHC, because CMHC has no issues being oh, you're using 3,000 when market is 2,800 or 2,500.
Yeah.
Yeah. Well, there goes 3% of your property value, whatever that correlating percentage is, right? They will 100% knock that value down, and they have no problem with that. And previously you didn't even have to have appraisals for over 25 units, but now that's a requirement. So definitely working with your appraiser or with a local realtor and saying, hey, I need to know exactly where market rents are going to be at, because I don't want to be planning for situation A and then CMHC comes back and I've lost all this value. And now I told my shareholders we were going to be paying them out on the back end, but hey, when you lose 500,000 in your value, that's your paybacks. I think the biggest thing from our perspective is rent for sure, but
especially in a market that's softening too. We especially in the GTA core, you're 5 to 8% on so far as of this year. So, significant softening overall in the GTA, and it's rippling out into these other markets. Kitchener-Waterloo is the highest vacancy it's had since the 90s. So, as you said, being conservative on overall
timing,
pro forma.
Timing in the market too. And maybe you can shed light into this more, but I've seen clients where you get quotes from your appraiser in the summertime and you're getting summertime rents, and then you go to rent out your building in December, January, and you're getting winter rates, and sometimes it is less, right? And even if you're $100 less a door on your rentals, you have 20 units, 30 units. that slowly chips away at what your value is going to be if you can't get that top dollar rent, depending on when you're trying to rent it out.
And for your your MLI Select, are you guys, how do they do the point system? Are your clients, is it the affordability or is it the energy efficiency that they are going for?
Sure. Yeah. In Ontario, the majority, 99% of all the applications are energy efficiency. Most of the time on new construction, there isn't a difference on leverage based on whether you get a 50 points or 100 points. It's all 95% on cost, and it's all 1.1 debt service. So the only difference really is increased dam. Most of the time, new construction investors and developers aren't committing to affordability in this case. Or if they are, it's 10%. So you 1 unit for every 10. So if you're doing something at scale, you might be able to get your 100 points there to get that 50 additional 10-year AM. But essentially the delta in which these developers are looking at is, what does it cost me from a value perspective versus, the increased amortization? Does it make sense do I spend X amount more dollars just to be able to access X amount more debt? Most of the time on these smaller mid-sized stuff, it doesn't make sense.
And who is it? CMHC who decides what's affordable?
It's based on median renter income, right? So 30% of whatever that number is, divide that out by your monthly payments. We're supposed to get updated numbers because we're still running on 2019 data, and the reason why they haven't updated is because they didn't want COVID skewed data to be used in the analysis. So They were supposed to come out October, November last year. They said it's coming out sometime in 2025, within hopefully the first couple quarters. So waiting and seeing, but it would definitely be nice to get a bump up in the allowances. Cause I mean, you look at like London, for example, and you're under $1,000. I think it's $990. I think affordable rent in London is like $990 a unit, which
It's impossible.
yeah,
Not getting that.
you're
It's
getting less than
impossible.
$1,000. It's pretty hard to make your project pencil, right? And I mean, in Kitchener-Waterloo, in Toronto, it's obviously difficult. I think it's like 13 something in Toronto, 1375 or something like that. Which, again, if you compare that to just a normalized market rent, you're pretty well under where you could get a 1-bedroom unit to be at. So I mean, it does make it difficult, and it does suck that they made that push by slashing the energy efficiency and really forcing people to get into the affordability market. I think it's we were finally, not that volume still isn't up, but people were really starting to get into the construction with the energy efficiency allowances, and it was just great to kind of see people being like, hey, we have a program that we can use, and let's get some shovels in the ground and start to build stuff. And I get that CMHC wants affordable rents, but I think that like by trying to force the affordability being there by pigeonholing people into one specific like qualifying parameter isn't really the way to go, when that there's going to be like a free market effect of just having new units on the ground is overall going to help bring rents down over time. But I just don't think they obviously didn't want to wait out that timeline. So
Yeah. I mean, the loopholes in the system in and of itself, the product is being amended as we go. I think there was a lot of great intention with the product when it came out. I believe they only anticipated like 5 or 10% of all applications being MLI Select, and the majority of our applications were going to be standard, as they always have. And then the floodgate opened, like max degenerate 95% leverage and 100 points off of being able to increase the efficiency of your building, in a time when interest rates were sky high. Like, it was the only way that really developers were able to make sense of it. But that being said, the difference between, if the difference of 40-year AM and 50-year AM is like the success of a project, you probably shouldn't be doing the project. But that being said, overall, one of the metrics that we're seeing drastically affect projects right now, or projects that were being underwritten, is increase in vacancy. Our population growth is quickly changing due to obviously policies federally and people leaving. What are you guys seeing? In real time, I'm sure you're watching this vacancy rate expand. Sometimes 200-300%. Downtown Toronto was like 1%. Now some are like 3.5-4% in like 12 months, which drastically change a pro forma. Are you guys seeing that right now?
On the increase of vacancy?
Yeah.
I think downtown, I don't know if the vacancy has shut up quite that much. Like, you still have all the immigration that's been coming in. I don't know, is there a big supply of new buildings that are causing the vacancy?
it could also be too. I mean, like,
CMHC's data is pretty
that's
pretty
what I was gonna
localized.
say, do you guys pull off of like CMHC's demographic map, like their neighborhood maps for vacancy, or are you guys using like your own mined data for the vacancy?
Yeah, well, I go off of the CoStar reports, which I think are more up to date. Like, if you log in today, that'll give you a report based on data up until today. So the CMHC, I think, is a bit lagging, and I don't know where they're pulling their data from. But
I mean, some of it's census track. I'm not going to pretend like I know where CMHC is getting all their data from, but I know they get pretty dialed in. I mean, like, even in Edmonton, for example, like, they can go by neighborhoods or by census tract, and like, you could be like, West Edmonton could be 3%, and then you could be like North Edmonton, and it could be like 2%, and it varies. Whereas obviously, depending on what you guys are looking at and how CoStar
has the submarkets too. So you want to go like, East York, or even downtown. Like, they've got like the financial district. You go Cabbagetown. They've got each little report for each micro neighborhood that you want to go into, and it'll give you a vacancy. It'll give you rental rates.
Yeah, you should take a look at CMHC's vacancy map versus what you have to see what the
very
variance
interesting.
is, because I was playing with it the other day, and the difference between last year's vacancy and this year's vacancy in some areas is like quite literally like 300% change in vacancy. So, then again, like,
Also
CMHC.
interesting where CMHC gets the data
Yes,
from.
yes,
too.
of course. But
Standpoint,
but something to keep in mind is like CMHC requires we use that number.
Yeah,
So
yeah.
whether or not you have your 2% in there, 1% or whatever it is,
Yep.
we underwrite our deal based off of the vacancy rate that's on their map.
Yeah.
If anybody actually wants to look at that data, you just go to CMHC, you go to Google, type in CMHC vacancy map, and you should be able to pop up like an interactive map to go and dig into it.
Yeah. What's in terms of like, like on the topic of like areas and whatnot, but like maybe like how do you guys differentiate between like B neighborhoods and A neighborhoods? Because obviously your cap rates like and vacancy areas do take an effect of that. But if you're taking a look at like AY like data, you guys have like your like low rise A, low rise B, high rise A, like. Obviously, high rise, low rise. But like, where do you guys start drawing the lines for like different markets and where you're determining?
So
like, the cap rates?
those are national benchmarks, the AY reports. For us, we will try to rely more on transactional cap rates in our reports. It's great that you can get the Colliers or Cushman, Avison Young reports, which have your general cap rates, but I think it's more important to look at what's been happening in the neighborhood, what are the transactions in and around you, and use those for your basis of concluding a cap rate.
How do you classify like an A, B, or C like area? Like how does that work?
In terms of, well, there's A and B like asset types.
Sure.
I'm not sure how they classify them as neighborhoods, but
because you always hear of like an investor being like, oh yeah, I'm buying in like a B class area, and you're just like, is that just like a bunch of bullshit, or like is that like how is that classified?
In the neighborhood or like the asset type?
That's a good question.
Well, I guess you guys it's low rise A, right? Or low rise A, low rise B. So that's more asset type than it would be.
Yeah, it's not necessarily
than
neighborhood
neighborhood,
based,
but-
it's
Gotcha.
asset type based.
And that would be just like based off of tenant profile or location?
Finishes,
Okay.
could be location in there as well. I'd have to look that up for you.
Interesting. Cool.
I know one thing a lot of people would want to know, though, jumping back to amortizations, is obviously remaining economical life is a big conversation piece. Buying an old building, what does that take a look like versus going through repositioning, and you can actually, force appreciate or I guess force appreciate, but force increase the remaining economical life of a building. Like, for listeners, like what do you guys look at when you're determining that value? Because obviously some people, they take a look at the building and they're going to be like, well, this building's going to be around for another like 80 years. How is my remaining economic life only, 25 or 30 or 35 years? Can you just let them know like what you look at and then maybe some of the things that they could do to increase that life?
Yeah, so one of the components of that is the effective age. So when was it built and how has the owner maintained the building, or did they have new furnace, new electrical, how up to date is it? And those things will go into the effective life and the remaining life of the building. You can look at all the old buildings in Toronto, they were built in 1890 and they're still standing. So, but every cycle of, 40 to 60 years, they need to have like a major renovation done to extend the remaining economic life. So for building owners, it's keeping it up to date and occasionally updating the major component systems in the buildings.
You're just essentially taking a look at when was the last time this stuff was updated and like, how long is it going to last?
And we're not building condition experts, so
course.
Yeah.
you can always go to an expert in that, and they'll tell you exactly what each component of your building, what the condition is and how many years it's got left.
Yeah. So if someone had, an argument to be made for increasing their remaining economic life, like would you ask to see like, hey, like, our best data point would be a building condition assessment report?
Yeah.
Okay. Yeah.
Yeah, because when we go on our inspections, like we're looking at that stuff, but we're not doing a detailed inspection of those.
Yeah.
Yeah, I mean, we advise a lot of our clients who are purchasing, pre-existing multifamilies to go out and get that building condition report. It not only does it give you an estimation of economic life, but it also outlines over the next 25 years your capital expenditure, what's required, when it's going to be. When you're taking on, a larger project and a larger building, it's great that you have cash flow and you've factored in like a maintenance cost into your budget, but if that maintenance cost is 5% or 6%, and then, your cash flow is like $2,000, but you have a $20,000 thing you got to deal with in 5 years, you don't really have any cash flow, and, you need to be able to manage those expenses properly. That's kind of one of the reports actually that a lot of people look over. It's not something that's required by the banks most of the time.
I think it's a mid-level market thing where, I don't know how much pushback you guys get on your fees. I'm sure there's pushback for how much appraisals cost these days, but I mean, I'd say most people don't want to spend another $2,500 on like a building condition report. But I mean, like you just said, if you take a look at what that report is actually going to tell you, it's going to outline your cost expenditures for the next 10 years, current, immediate, what's going to be happening with the next period of time. But it's also giving you an idea if you're getting into a building, like a repositioning of a pre-existing asset, and your purchase appraisal comes back with a 25-year, remaining economical life. That report is going to outline you how do you get to a 50-year, economical life, and that's going to be the difference between your 25, 30-year amortizations and your 50-year AM, which is a huge amount on your cash flow and your debt servicing qualification.
Sometimes it's just peace of mind for the buyer, right?
For sure.
Maybe there's a big structural issue that you didn't know about, and you're able to get out of a deal that otherwise you would have been stuck with costly repairs and 1 or 2 years.
Most people take on average, I'd say there's probably more 10-year approvals. I mean, you're going to be holding the building for 10 years anyways, because that's going to be your term with CMHC. Like, how easy is it now to be able to cash flow predict a model over the next 10 years when you have a report that, quite accurately outlines what your capital costs, expenditures are going to be over the next 10 years? Like, that is going to be a key model.
Yeah.
So especially if you're, privately raising, you bring some investors on or some shareholders that are expected to be paid out at some point. Again, to be able to accurately reflect that and tell them, hey, this is our cash flow model, but this is the expenditure cost of the next 10 years. You're completing your whole portfolio analysis, not just I'm buying this property, I'm locking up for 10 years, and I'm guessing that the repairs and maintenance on average are going to be 4%.
Yeah, because that benchmark is not reflective of an older building and maintaining a building like that. One of the major challenges we see with mid-market investors is just the lack of capital when they do and take on the building. The amount of capital it truly requires to stabilize an old building, like a 70s walk-up building. You got a roof, interiors, exteriors, probably the heating systems. You probably got old plumbing in there. A lot of capital is required to take on these projects.
Well, when it's the same, expense ratio for a brand new construction in a pre-existing building, that it's not the most accurate data point, right? It can't be 4% for a brand new building and 4% for an 80-year-old building. There's got to be some discrepancy.
I think the CMHC benchmarks do a good job with more accurate repairs and maintenance. I think it's $830 per suite for wood frame and $975 per unit for concrete building.
Yeah,
so
absolutely.
When you get these, pro formas from your clients and they've got, $200 a suite for repairs and maintenance. Sometimes they don't even have it. They're like, I spent $800 last year, so that's what the repairs and maintenance is. No, this will, at least the CMHC benchmarks is a little more accurate.
Yeah,
absolutely. Gotta remind other realtors there's such thing as a maintenance cost and a management fee.
Oh, the management fee. I manage it myself.
Yeah. The classic manage it myself.
And there's no vacancy, so there's a zero vacancy.
No, it's fully leased.
Classic.
Can't tell you how many pro formas. If you guys are listening, factor in a maintenance management fee.
Yeah, the bank's going to do it anyway.
100%. A bank's looking at it as if I got to take over this building.
Yep.
And the bank's not going to manage the building, right? They're going to hire someone. Yeah. So, they're hiring all this stuff worst case. And I mean, it's also a good point too to understand when you're reviewing, any sort of income and expense, whether it's from what you guys provide or whether it's what we give you on the CMHC underwriting, you're going to have your fixed expenses that are happening every month. So, I mean, you're going to have your utility costs, your insurance, your property taxes. But when you're trying to have an understanding of how much net, cash flow you're actually getting back per month, you're not paying a vacancy expense every single month. The bank is putting that in place because they want to ensure that you're going to maintain cash flow in the event of vacancy. So, there's understanding there is a slight difference in your NOI, your net cash flow based upon CMHC's underwriting and their conservative benchmarks and what you should put into your underwriting to ensure the model is safeguarded, but also you are going to get some of those back per month because it's not going to be a fixed expense, right? You're not replacing your appliance every single month, right? So you're not having that full replacement there. You're not paying vacancy especially if you're coming in with a fully tenanted building. So again, like just understanding that when we give you these numbers, we're using these data sheets that are provided to us from CMHC. It's not going to be your actual net cash flow. You can add some of that back, but again, those numbers there are to safeguard you.
And I always tell people it's vacancy and bad debt or collection allowance, because some of these markets, you're not always collecting from your tenants.
Yeah.
So takes that into account too.
100%. Yeah.
Pro formas in and of itself are challenging for a lot of investors, and when they're looking at writing a pro forma or outlining success, usually what Aaron and I will do, we'll take a look at the current operations of a building and then the maximum operations of a building based off market, and then probably say like 50% of that delta is like a successful project. If you can increase the efficiency of that by 50%, that's success. A lot of the times when you're looking at projecting out a value on that, most people will be like, it's a 4 cap, it's a 5 cap. But if you're looking at trying to project out that cap rate obviously incrementally changes based off of how stabilized the building is.
Yeah.
Do you have any advice as to how somebody would go about kind of projecting that out? Do they just kind of call Graham up and say, "Hey, Graham, I'm putting the pro forma together. Can you help me?" Or the cap rate's smaller based off of a fully stabilized building versus larger.
If you have a building that's 50% at market and the other 50% is long-term tenants, then the cap rate might be a little lower because you got some room to increase rents upon turnover. But if you're a brand new building at all market rents, then it's going to be at the higher end of your cap rate range because nobody's paying a lower cap rate for something that's already fully stabilized.
Mm-hmm.
Yeah, absolutely. So, if they were to, run numbers, and obviously you can't get in touch with your favorite mortgage brokers, you wanted to call someone, you would call,
Call me.
Call your appraiser, yeah?
Yeah, why not? Call the appraiser.
Right. Yeah, you guys have the best data as to what's happening in the market as it's happening, which is the most important thing because, the goalposts change, whether it's our business, your business, debt, the cost of debt changes, values change very quickly, market sentiment shifts on a dime, and it's important to work with people who know what they're doing. 2025 just showed up. We have a lot of uncertainty in the market right now. Things are moving and things are happening, and the listeners really want to understand if you had one piece of good advice from the value perspective, for an investor who's going to be investing this year, what would that be and what would you leave them with?
I would say, look, if they are considering buying a building and they're not sure, what it should be worth, they pick up the phone, they give us a call, and, we'll go over it with them prior to just be like, hey, if I can support this, then you're good to go in at that purchase price. I'll go over it with them, go over some direct comparison sales, maybe run the income. Be like, looks like we can support this. So then you have the peace of mind that the appraisal will be, supporting your purchase.
Recommendations on accepting seller-provided appraisals if you're a buyer?
You got to check out the effective date, and those appraisals are done for the seller, right? They're
100%.
My spidey senses always tingle when the seller's providing any sort of supporting DD document, though. I don't like it.
I agree.
Graham, absolute pleasure having you on today. If people want to get in contact with you, we'll put your contact information below so they can connect with you. But we really appreciate you coming on the podcast.
Well, that flew by. Said an hour already.
Yeah. In and out.
I appreciate you guys having me. This is great. So, if any of your clients want to reach out for an appraisal, I'll let you put them in contact.
Do you want to just let them know quick, what area you're in? Or
I know you guys do a lot of multifamily, so we will cover anywhere in Ontario that you're buying or refinancing, or maybe you just want internal valuation purposes, you want to know what it's worth, just reach out and we'll get you an appraisal.
You now have an AY team member, guys.
It won't be me personally, but I'll send one of the candidates out to inspect it.
Amazing. Well, thanks so much for your time.
All right. Thanks, guys.
Ciao.
Yeah.